Welcome to our next podcast episode.
Thank you. It is a vital subject we are tackling today.
It really is. I mean, imagine allocating $50 million to acquire a premium commercial asset,
Right.
only to watch your entire equity stack just evaporate 24 months later. And all because a buried environmental leak triggered a technical default on your mezzanine debt.
It is a catastrophic scenario, but it happens far more often than people realize.
Exactly. In the institutional commercial real estate sector, mathematical precision and, well, structural foresight are really the only barriers between compounding generational wealth and absolute capital erosion.
Precisely.
So today we are commencing a rigorous executive review of the foundational strategies within commercial real estate investment.
And our focus for this deep dive is directed toward the comprehensive framework presented in the book Practical Principles of Commercial Real Estate Investment, which is authored by Willem Tait.
Right. The core mission of this executive audio masterclass is to extract the core commercial real estate business strategies from his writing. We want to outline unyielding investment frameworks and actionable growth insights derived directly from his publication.
Which is incredibly valuable for our listeners.
Yes, because by the conclusion of the session, you will possess a comprehensive, data-driven architecture for evaluating, financing, managing, and ultimately disposing of commercial real estate assets.
This knowledge is specifically structured to empower your executive decision-making processes.
Exactly. It facilitates strategic, risk-adjusted portfolio growth.
But before deploying capital based on these frameworks, it is mandatory to vet the architect of the strategies.
Absolutely. Willem Tait is an established author, and he has a very diverse portfolio of publications.
He does.
Professionally, he does not merely operate in the theoretical domain. He actually functions as a management consultant, an enterprise strategist, and a retained advisory specialist.
Right. He is deeply engaged in the professional sphere. Yes. He works as a coach, a mentor, and a public speaker, bringing a massive amount of frontline advisory experience to his writing.
So his frameworks are genuinely battle-tested in the realities of the modern corporate real estate environment.
They are.
For executives seeking to integrate his methodologies directly into their own corporate structures, you are explicitly directed to the Linktree URL located in the bio of this podcast.
That link provides the most direct and efficient avenue to explore his professional consultancy offerings, right?
Yes, it does. It also serves as the centralized gateway to his academic research papers, which are hosted on academia.edu.
And you can also find his regular analytical insights published on platforms such as medium.com and substack.com through that same link.
Exactly. Now, it is also necessary to confirm the global availability of his methodologies.
Right. His books, including the volume under our analysis today, are distributed globally through major institutional and retail channels.
Specifically, this title can be acquired via Amazon, Apple Books, Walmart, Barnes & Noble, Bowl.com, Waterstones, and Exclusive Books.
But concurrently, we must emphasize a highly effective, cost-neutral acquisition strategy for this intellectual capital.
Yes, this is a critical focus. We explicitly direct you to take immediate action by emailing or messaging your local librarian.
You should formally request that Practical Principles of Commercial Real Estate Investment be added to the library's digital portfolio.
Right. Executing this step operates as a strategic leverage play.
It does. It allows you, as well as your wider corporate and local community, to access and read the work completely free of charge.
Exactly, via mainstream library lending applications such as Overdrive, Libby, Hoopla, or Odilo.
Utilizing that digital library infrastructure efficiently democratizes executive-level knowledge while preserving your own operational capital.
Well said. So, to execute a sophisticated investment strategy, an executive must first accurately categorize the operational environment.
Right, which means we begin by dissecting the foundational classification of commercial asset classes, as detailed in Tait's book.
The fundamental shift an executive must achieve when transitioning from residential to commercial real estate is the absolute elimination of emotional acquisition bias.
That is crucial. Commercial real estate demands capital deployment decisions grounded strictly in financial metrics.
Right. Financial metrics, tenant demand forecasts, and macroeconomic market trends.
Exactly. And in his book, Tait outlines 4 primary commercial property types that really form the basis of a diversified institutional portfolio.
Let's walk through those.
The first of these operational classifications is office buildings. And Tait further segregates these into distinct risk-return tiers.
Class A being the premium tier, I assume?
Yes. Class A properties represent the premium tier. These are typically located in central business districts, feature state-of-the-art infrastructural amenities, and hold rigorous energy-efficient certifications.
And they secure multinational, high-credit corporate tenants.
Exactly. Then you have Class B properties, which cater to mid-size enterprises. These are value-driven assets that may be slightly older, but remain highly functional.
They are often situated in suburban business parks, right?
Correct. And finally, Class C properties are older structures in secondary or tertiary locations. They generally require significant capital expenditure and structural repositioning to remain competitive.
Right. Now, the second classification is retail spaces. His writing reflects that this category spans a highly volatile spectrum.
It does. It ranges from standalone single-tenant properties to expansive shopping centers anchored by major grocery conglomerates.
And the operational viability of retail assets is inextricably linked to localized consumer demographics.
Yes, as well as vehicular accessibility and consistent daily footfall.
The third category, industrial facilities, encompasses warehouses, manufacturing plants, and flexible workspaces.
And Tate explicitly emphasizes the current structural surge in industrial demand in this book.
Right, which is a macroeconomic trend largely driven by the aggressive expansion of e-commerce logistics.
Exactly. That and hyper-localized last-mile delivery requirements, plus the fundamental restructuring of global supply chains post-2020.
Finally, he identifies mixed-use developments. These strategically blend residential, commercial, and retail elements to create self-sustaining urban microeconomies.
Which capitalizes on the demographic shift toward walkable, integrated living and working environments.
When we critically analyze these classifications, it becomes pretty evident that each asset class dictates a highly specific risk-return profile.
It does. For instance, industrial properties currently offer robust yield stability and predictable cash flows.
Due to the inflexible structural logistical demands of the modern global economy, right?
Exactly. The e-commerce sector requires vast, uninterrupted warehousing capabilities. That ensures long-term tenant commitment and very low turnover rates.
Conversely, retail real estate demands a highly sophisticated, almost real-time understanding of consumer behavior.
The risk profile is significantly elevated there. The landlord's operational success is entirely contingent upon the tenant's commercial success.
Right, and broader, often unpredictable consumer spending trends.
And then office spaces offer theoretical corporate stability, but currently they are highly sensitive to systemic shifts in employment models.
You mean the widespread adoption of remote or hybrid operational structures?
Exactly.
You know, if we translate these real estate asset classes through the analytical lens of a corporate stock portfolio, a precise analogy actually emerges.
Oh.
How so? Well, office buildings, particularly premium Class A properties, function identically to blue-chip dividend stocks. They offer prestige and baseline stability, but are highly sensitive to broad macroeconomic trends.
Right, and corporate employment cycles. That makes sense.
Meanwhile, industrial flex spaces act as aggressive growth stocks, rapidly capitalizing on the e-commerce boom and supply chain evolutions.
That is a strong analogy.
Given this paradigm, an executive cannot simply collect assets at random. How does Tate recommend balancing these varied asset equities within a singular, optimized enterprise portfolio? I mean, how do you hedge against sector-specific downturns?
Well, in his book, Tate addresses this portfolio architecture by advocating for strategic, counter-cyclical diversification.
Meaning he explicitly rejects a uniform allocation model.
Correct. His approach to balancing these assets involves cross-referencing the current phase of the macroeconomic cycle against localized market indicators.
Can you give an example of how that works in practice?
Certainly. An executive might anchor their portfolio with highly stable industrial assets to generate a reliable baseline cash flow.
Okay.
That predictable yield is then utilized to mitigate the higher volatility associated with acquiring, say, a value-add Class C office building.
One intended for aggressive renovation and market repositioning.
Exactly. The objective is to utilize the bond-like yields of one asset class to underwrite the operational and capital expenditure risks of another.
Creating a resilient, blended enterprise yield that withstands isolated sector volatility.
Precisely.
However, understanding the theoretical mechanics of these asset classes is essentially useless without the rigorous capability to identify the specific geographic and economic environments where these assets will actually perform optimally.
Right. Which means our analysis must transition into the methodology for site selection and the precise financial metrics utilized to evaluate them, as presented in Tate's writing.
Tait identifies three critical pillars of market intelligence that must unconditionally precede any capital deployment.
First, granular demographic analysis. And he emphasizes that this extends far beyond simple population counts.
It requires scrutinizing population growth trajectories, generational age distribution shifts, and median household income trajectories.
Because a growing, upwardly mobile population inherently signals future demand for commercial space.
Right. Second, localized economic indicators are evaluated. This encompasses regional gross domestic product output, sector-specific employment growth, and the structural diversity of the prevailing industries.
That structural diversity is key. A market reliant on a single corporate employer or a singular industry presents an unacceptable concentrated risk profile.
Whereas a diversified economic base offers baseline resilience against corporate downsizing.
Exactly. And third, macroeconomic market trends must be quantified, specifically through tracking historical, current, and aggressively projected vacancy rates.
Alongside the precise trajectory of commercial rental growth.
Right. Following this macro-level market research, the focus narrows to hyper-specific site selection.
And in this book, Tait emphasizes that proximity to structural demand drivers is absolutely non-negotiable.
This includes adjacency to major mass transit hubs, interstate highway networks, and essential corporate amenities.
Furthermore, he stresses strict, uncompromising adherence to municipal zoning and land use regulations.
You have to ensure the intended commercial activity is legally permissible without requiring variances.
To execute this level analysis, Tait advocates for the mandatory integration of advanced enterprise technology.
Yes. Geographic Information Systems, or GIS, and high-resolution drone surveys for topographical and infrastructural analysis.
And AI-driven predictive analytics platforms.
Yeah.
He argues these are no longer optional, right?
Correct. They are presented as mandatory tools for rigorous contemporary market intelligence.
Once a viable site survives this technological vetting process, the evaluation must transition immediately to strict financial mathematics.
Tait's book breaks down the core metrics of commercial real estate evaluation. These are often considered the holy trinity of the sector's financial modeling.
We're looking at net operating income, the capitalization rate, and the cash-on-cash return.
Yes, but the application of these metrics requires serious executive scrutiny.
Right. Let's take net operating income, or NOI. It is calculated by subtracting all operating expenses from gross income. It is the purest measure of a property's operational profitability.
Yet an executive must normalize the NOI during due diligence.
Exactly. We are not simply defining NOI, we must acknowledge how it is manipulated.
That is a vital point.
An executive evaluating a target acquisition must scrutinize the seller's stated operating expenses. Sellers frequently attempt to classify standard recurring maintenance as one-time capital expenditures.
Right, to remove them from the NOI calculation.
Thereby artificially inflating the property's apparent profitability right before a sale.
Tait's methodology requires a forensic audit of the trailing 12 months of financials to strip away these accounting maneuvers.
Similarly, the capitalization rate, derived by dividing the normalized NOI by the property's market value, requires a deeper psychological analysis of market sentiment.
That is a critical interpretation. The cap rate is not merely a yield metric. It is essentially a mathematical quantification of market fear versus market confidence.
Explain that dynamic.
Well, a lower cap rate, perhaps a 4% yield in a prime urban center, indicates that institutional capital views the asset as highly secure.
The probability of tenant default or extended vacancy is statistically negligible.
Right. The investor accepts a lower yield because the capital preservation is nearly absolute.
Conversely, a higher cap rate, an 8 or 9% yield, suggests higher potential returns.
But this yield premium exists solely to compensate the investor for absorbing a higher inherent risk.
Such as a secondary market location, deteriorating structural infrastructure, or volatile tenant credit profiles.
Precisely.
Now, this mathematical methodology relies heavily on the extrapolation of existing data. However, if predictive analytics, GIS mapping, and demographic trends primarily map the past and the present, how does an executive account for unprecedented municipal zoning shifts or black swan economic events?
It is a profound challenge.
In his book, how does Tait approach the absolute necessity of stress testing these financial models against unforeseen systemic macro shocks?
Tait addresses this structural vulnerability by insisting on rigorous, almost pessimistic scenario modeling.
Interesting.
His writing reflects that an executive must never rely solely on a best case or even a base case pro forma. True stress testing involves artificially and severely manipulating the variables within the cash flow model.
Give me an example of how severe that modeling should be.
For example, Tait advises modeling the financial outcome if vacancy rates spike by 20% overnight, or if the Federal Reserve increases interest rates by 300 basis points over a short 6-month duration.
That is incredibly aggressive modeling.
It is. By calculating the debt service coverage ratio under these severe conditions, the investor determines the exact threshold at which the property ceases to break even and begins consuming external capital.
And if the margin of safety is too narrow under stress conditions.
Tait's framework dictates that the acquisition must be abandoned immediately, regardless of how attractive the historical trailing data appears.
That is a very disciplined approach. Now, once an asset is identified, forensically audited, and mathematically justified through the stress-tested metrics we have discussed, the acquisition must be aggressively funded and legally secured.
Right. We must now examine the strategic approaches to capital deployment, leverage optimization, and regulatory compliance as detailed in Tait's book.
The financing architecture of commercial real estate is broadly categorized into traditional and creative methodologies.
Traditional financing primarily involves conventional institutional bank loans, which generally require a substantial equity injection.
Typically, 20 to 30% of the total purchase price, correct?
Yes, and they often feature fixed interest rates over a 5 to 10-year term. But for larger-scale institutional acquisitions, executives frequently utilize commercial mortgage-backed securities, or CMBS.
These are debt obligations that are pooled and sold to institutional investors as securities on the secondary market.
Right. They are particularly advantageous for massive transactions because they often offer non-recourse funding.
Meaning the borrower's parent company or personal assets are entirely shielded from liability in the event of an operational default.
Exactly.
Beyond these traditional routes, Tait outlines creative, highly structured financing strategies designed to provide capital agility in complex competitive transactions.
Bridge loans, for instance, they serve as rapid, short-term capital solutions.
Allowing an investor to secure an acquisition and close quickly while permanent, long-term financing is negotiated in the background.
Yes. Mezzanine financing is another highly critical tool in the executive arsenal. It essentially combines elements of debt and equity.
It allows investors to access supplementary capital without diluting their primary equity ownership stake.
Furthermore, the book discusses corporate crowdfunding and syndication as modern mechanisms for diversified capital pooling,
Enabling lead sponsors to aggregate capital from multiple institutional or accredited parties to fund large-scale acquisitions.
But to optimize these complex structures, Tait advises maintaining a total loan-to-value, or LTV ratio, strictly below 70%.
Because that specific threshold balances the return-amplifying advantages of leverage with a strictly manageable risk profile.
Exactly. Now, the legal framework insulating the asset is equally critical to the capitalization structure.
Yes, Tait emphasizes the absolute, non-negotiable necessity of conducting Phase I environmental site assessments.
Deploying capital into a commercial property without an ESA exposes the purchasing entity to strict retroactive liability for pre-existing environmental contamination,
And the remediation costs of which can easily bankrupt a special purpose vehicle.
without a doubt. Furthermore, rigorous title searches are mandatory to ensure there are no hidden mechanic lanes, tax encumbrances, or easement disputes.
Finally, verifying strict documented adherence to municipal zoning laws prevents the catastrophic acquisition of an asset that cannot legally be utilized for its underwritten commercial purpose.
Right.
Returning to the financing structures, the utility of mezzanine financing in high-stakes development projects requires further unpacking. It acts as a crucial financial buffer within the capital stack.
It does.
If we apply an enterprise analogy, viewing the overall capital stack of a real estate transaction as a standard corporate balance sheet, mezzanine debt functions precisely like preferred stock.
That is an excellent way to conceptualize it.
It sits subordinate to the senior secured debt from the primary banking institution, but it holds priority over the common equity provided by the sponsor. While this preserves equity control, it introduces severe leverage risk.
It absolutely does.
What specific systemic dangers does Tait highlight regarding the over-leveraging of this capital stack, particularly when operating within a volatile, fluctuating interest rate environment?
The specific catastrophic danger Tait highlights is the rapid compression of the asset's cash flow.
How so?
Well, in his book, he explains that while leverage mathematically amplifies returns on equity during stable economic periods, it equally amplifies exposure during volatility.
Okay.
If an executive pushes their combined loan-to-value ratio up to 85 or 90% using expensive mezzanine debt, the corresponding monthly debt service burden becomes immense.
Right. And in a fluctuating macroeconomic environment, if the primary senior debt is structured with a floating rate, an upward shift by the central bank can be devastating.
Exactly. It can cause the total debt obligations to suddenly exceed the property's net operating income.
And when this inversion occurs, the investor is forced to feed the property with external capital from their corporate reserves to prevent a technical default.
Yes. If they cannot meet the capital call, the mezzanine lender typically has the legal right to foreclose on the equity, wiping out the sponsor's entire investment.
So Tate's strict adherence to the 70% LTV ceiling is really a defensive architecture.
It is designed to ensure that even if interest rates spike or tenant income temporarily retracts, the property generates sufficient internal cash flow to service all debt obligations independently.
Securing the asset and finalizing a defensive capital structure represents merely the commencement of the investment lifecycle.
True. The true compounding enterprise value of a commercial property is generated and sustained exclusively through operational excellence and optimized tenant yield.
Which means we must now transition to the comprehensive breakdown of lease architectures and property management protocols presented in Tate's writing.
The foundational legal document governing that tenant yield is the commercial lease agreement. And Tait outlines in his book 3 primary lease architectures.
Each fundamentally altering the risk profile of the investment, right?
Exactly. The first is the gross lease, wherein the tenant pays a single fixed rental amount.
And the landlord retains the responsibility for all property-related operating expenses.
Right, including municipal taxes, building insurance, and all structural and aesthetic maintenance.
This structure provides budget certainty for the tenant, but it shifts the entire risk of escalating operational costs and inflation entirely onto the landlord's balance sheet.
Which brings us to the second and arguably most critical structure for institutional capital: net leases.
These are categorized as single, double, or triple net, universally denoted in the industry as NNN.
In a triple net lease, the severe financial burden of property taxes, building insurance, and comprehensive maintenance costs is contractually shifted from the landlord directly to the tenant.
This architecture effectively stabilizes the landlord's net operating income. It entirely isolates their yield from operational inflation and unpredictable tax assessments.
And the third structure is the percentage lease, predominantly utilized in the retail sector.
Under this agreement, the retail tenant pays a reduced baseline rent plus a predetermined percentage of their gross sales revenue over a specific breakpoint.
It creates a symbiotic, venture capital-style financial relationship. It aligns the landlord's financial incentives directly with the retail tenant's commercial success.
Beyond the fundamental lease type, Tait identifies key structural components within the lease that must be rigorously negotiated by legal counsel.
Rent escalation clauses are paramount. These must be explicitly tied to consumer price index inflation metrics or set at fixed, aggressive annual percentages.
To prevent the silent erosion of real income over a 10-year lease term?
Exactly. The lease must also delineate precise maintenance responsibilities, leaving zero ambiguity regarding which party is financially responsible for structural replacements versus routine aesthetic repairs.
Furthermore, early termination clauses and renewal options must be structured strategically.
Right, to provide the landlord with sufficient operational flexibility to reposition the asset while offering the corporate tenant necessary business continuity.
Now, effective property management is the operational enforcement mechanism that upholds the lease and preserves the physical asset.
The book emphasizes proactive, preventative maintenance over reactive emergency repairs.
It also highlights the implementation of highly structured corporate tenant retention programs and the mandatory establishment of localized capital reserve funds.
Specifically, Tait recommends contractually setting aside a fixed percentage, such as 5% of gross annual income, exclusively for capital expenditures.
This ensures liquidity is available to fund major future repairs, such as roof replacements or commercial HVAC system overhauls, without requiring a sudden capital call from investors.
Furthermore, he advocates for the heavy integration of PropTech.
Right, embracing advanced property management software such as AppFolio or Buildium.
And deploying digital tenant communication portals, as well as utilizing smart IoT-enabled energy management systems to optimize utility consumption and drive down aggregate operating expenses.
Analyzing these lease structures, the strategic advantage of the triple net lease is highly attractive for institutional executives seeking passive, bond-like returns.
It is. By legally offloading the operational and inflationary expenses, the income stream becomes highly predictable and insulated.
This contrasts sharply with the active, highly intensive management required to optimize a percentage lease in a massive retail center.
Very true. In that scenario, the landlord must operate almost as a retail consultant, constantly monitoring tenant sales performance and auditing foot traffic metrics.
And driving overall center marketing to stimulate the top-line revenue upon which their percentage yield is fundamentally based.
However, this raises a critical systemic operational question regarding the triple net structure.
Yes, I wanted to ask about this. If we shift all comprehensive maintenance costs and responsibilities to the corporate tenant via a NNN lease, does this not inherently create a massive conflict of interest?
In what way?
Well, one that could degrade the physical asset over the long term. If a tenant is incentivized to maximize their own corporate profits and shareholder returns, they will naturally choose to cut corners on structural maintenance, deferring necessary but invisible repairs.
That is a very valid concern.
How does Tait recommend structuring executive oversight into a triple net lease to defensively protect the core value of the underlying physical asset?
That is indeed the fundamental vulnerability of the NNN structure. His writing reflects that a landlord cannot simply abdicate operational responsibility once the lease is fully executed.
So what is the protocol?
To mitigate this systemic risk, Tait advises embedding strict, non-negotiable compliance and inspection clauses directly within the lease agreement.
Meaning the landlord must legally retain the right to conduct scheduled, comprehensive physical and engineering inspections of the property on a biannual basis.
Exactly. Furthermore, the lease should mandate that the tenant utilize only landlord-approved, certified commercial contractors for any significant maintenance or repair work.
Crucially, the lease must require the tenant to submit documented annual logs of preventative maintenance performed on critical systems like HVAC, plumbing, and structural roofing.
This rigorous compliance architecture ensures that the tenant's internal cost-saving measures do not result in the silent, catastrophic degradation of the landlord's underlying asset.
Preserving the property's value for eventual disposal.
Right.
Operational excellence must not only be shielded from tenant negligence, but it must also be fortified against macro-environmental shocks.
And simultaneously optimized for complex state and federal regulatory compliance.
Which leads us into the architecture of enterprise risk management and the highly strategic, highly lucrative domain of tax capitalization as outlined by Tait.
Risk within institutional commercial real estate is multifaceted and omnipresent.
Tait categorizes these operational threats into market volatility, financial exposure, specifically regarding interest rate fluctuations and impending debt maturity cliffs operational inefficiencies, and sudden environmental or regulatory shifts.
To address these aggressively, Tait advocates for the establishment of a designated cross-functional crisis management protocol.
An executive must not wait for a catastrophic event to assemble a response team.
No, absolutely not. The book highlights a specific, highly relevant case study concerning a sudden, multi-floor corporate tenant default.
The prescribed protocol involves immediately deploying retained legal counsel to enforce the lease terms and secure the asset,
while concurrently negotiating a viable, structured repayment plan if the tenant's core business is salvageable.
And simultaneously initiating an aggressive remarketing campaign for the space to strictly minimize the void period and subsequent income hemorrhage.
The preservation of capital during a crisis is vital, yes, but the exponential acceleration of capital accumulation during stable periods is achieved through advanced tax strategies.
In his book, Tait outlines several crucial legally sanctioned mechanisms for maximizing return on investment through sophisticated tax architecture.
The first is standard commercial depreciation, utilizing the 39-year schedule mandated by the federal tax code to reduce taxable income through a non-cash paper deduction.
The second, significantly more aggressive strategy is cost segregation.
This involved deploying specialized engineering firms to conduct a granular study of the asset.
Identifying specific property components, such as specialized technological fixtures, customized carpeting, or complex exterior landscaping, that can be legally reclassified.
Right, and depreciated on highly accelerated schedules of 5, 7, or 15 years.
Furthermore, Tait meticulously details the mechanics of the 1031 exchange.
This powerful section of the tax code allows an investor to completely defer massive capital gains taxes upon the sale of a highly appreciated asset.
provided they identify a replacement like-kind property within a strict 45-day window and successfully close the acquisition within 180 days.
Finally, the book examines the complexities of opportunity zones, which offer substantial federal tax deferrals and potential absolute tax eliminations.
For capital gains that are deliberately reinvested into specific government-designated low-income tracts and held for long-term durations, typically exceeding a mandatory 10-year hold period.
The mathematical compounding power of combining these strategies sequentially is profound.
It really is. Consider a highly realistic enterprise scenario.
Walk us through it.
If an executive utilizes a 1031 exchange to move $10 million of equity from a mature, fully depreciated asset into a larger, newly acquired $20 million facility, they preserve their entire equity base completely tax-free.
Right.
If they immediately execute a cost segregation engineering study on the new $20 million asset, they can generate massive, accelerated paper losses in the initial years of ownership.
This architecture allows the executive to continuously compound their wealth tax-deferred.
Utilizing the new asset's cash flow while simultaneously shielding that precise cash flow from immediate tax liabilities due to the phantom losses generated by the accelerated depreciation.
Precisely. This structural approach effectively transforms a massive tax liability into immediate, deployable working capital.
However, the legislation surrounding these benefits is fiercely stringent.
It is. Failure to comply with the exact unforgiving timelines of a 1031 exchange, for instance, results in immediate capital gains taxation and the application of severe compounding financial penalties from the Revenue Service.
It requires absolute executive precision.
It does.
Regarding opportunity zones, the concept theoretically sounds like a tax utopia for the institutional investor seeking to eliminate long-term capital gains.
On paper, yes.
However, we must aggressively ground this in the reality of real estate fundamentals based on Tait's writing. What are the intrinsic structural market risks of deploying millions in capital into low-income government-designated zones simply to chase a federal tax break, rather than investing based on organic, proven market demand?
In this book, Tait explicitly and forcefully warns against letting the tax tail wag the investment dog.
A great phrase.
The intrinsic risk of opportunity zones is that these geographic areas are designated precisely because they lack organic economic drivers, robust demographics, or reliable existing infrastructure.
Right.
If an investor acquires a multi-million-dollar asset solely for the back-end tax elimination benefit at the 10-year mark, but the underlying location fails to attract reliable corporate tenants or achieve projected rental growth, the operational cash bleed over that decade will far exceed the eventual tax savings.
So Tait's methodology dictates a strict rule.
Yes. An opportunity zone investment must first underwrite successfully as a standard, viable, highly profitable commercial real estate deal based on its own merits before the tax benefits are even factored into the financial modeling.
The tax benefit is a strategic enhancement, never the foundational justification for the acquisition.
Exactly.
Having successfully stabilized the initial assets, implemented rigorous operational and compliance protocols, and thoroughly optimized the enterprise tax architecture, the focus of the executive must invariably shift toward macro portfolio scaling and the strategic eventual exit strategy.
Which means we conclude our analytical review with Tait's frameworks for portfolio growth and the calculated disposal of stabilized assets.
Scaling a commercial real estate portfolio requires deliberate, systematic, and data-driven expansion.
Tait outlines several core strategies for achieving this enterprise growth. The first is geographic expansion, deliberately moving capital into secondary or tertiary markets that demonstrate early, quantifiable indicators of population growth and significant municipal infrastructure investment.
The second is asset type diversification, ensuring the broader portfolio is not overly concentrated in a single sector, such as retail,
thereby structurally insulating the overall enterprise from sector-specific macroeconomic recessions.
Thirdly, he emphasizes aggressively leveraging economies of scale.
As the portfolio's square footage grows, the executive must implement centralized corporate management systems and negotiate bulk vendor contracts for essential services like security, HVAC maintenance, and landscaping,
to drive down aggregate operating expenses across the entire portfolio.
To fund this rapid expansion, Tait suggests utilizing syndication and joint ventures to pool external institutional capital, thereby spreading risk and amplifying purchasing power.
Equally critical to acquisition and scaling is the execution of the disposal strategy.
Tate's writing reflects that understanding precisely when and how to sell is a fundamental, non-negotiable executive competency.
Recognizing macroeconomic market peaks and identifying the exact moment an asset has hit its operational and financial ROI ceilings are crucial analytical skills.
He introduces the highly effective concept of the running exit file.
This is a continuous, perpetually updated tracking mechanism for every single asset in the portfolio, right?
Yes, it requires monitoring prevailing market rents in the immediate geographic node, localized vacancy rates, and the impending long-term trajectory of required capital expenditures.
By maintaining this strict data set, the decision to dispose of an asset is driven entirely by quantitative metrics, completely devoid of emotional attachment to the property.
Preparation for the ultimate sale is a meticulous, highly choreographed process.
Months before listing an asset, the executive must systematically cure all deferred structural maintenance.
Ensure all current corporate leases are stabilized, properly documented, and extended where possible, and present entirely transparent, fully reconciled, institutional-grade financial statements to prospective buyers.
Furthermore, the reinvestment of the eventual proceeds must be entirely pre-planned.
Tate insists that an investor must know precisely where the net capital will be deployed, whether into expanding the portfolio via a seamless 1031 exchange or strategically paying down floating-rate debt on other vulnerable assets, long before the sale is actually triggered.
Tate's philosophy regarding asset disposal is highly definitive and instructive. He posits that selling an asset is not an admission of operational failure, but rather a mark of rigorous institutional professionalism.
Strategically rotating capital out of mature assets that have reached their income ceiling and deploying that extracted equity into newer, greener, or strategically superior locations is vital.
It is the primary defensive mechanism to prevent silent value erosion, an insidious process which occurs naturally when a building ages, structural maintenance costs aggressively accelerate, and the surrounding market dynamics shift geographically away from the property's specific location.
This strategic capital rotation is the absolute hallmark of a dynamic, professionally managed enterprise portfolio.
It ensures that deployed capital is never stagnant and is continually aggressively positioned in assets that offer the highest possible risk-adjusted returns based on current, real-time macroeconomic conditions.
Absolutely.
We can apply the clear analogy of pruning a mature, complex tree. Cutting away older, heavy branches is not an act of destruction. It is a calculated, necessary requirement to stimulate new, vigorous growth in other areas of the organism.
By removing the asset that demands the most operational energy for the least yield, the entire enterprise thrives.
However, Tate issues a strong, unambiguous warning against the devastating consequences of selling under pressure. How does establishing a robust, highly liquid capital reserve, as advocated relentlessly throughout his book, prevent an investor from becoming a forced seller during a severe downward economic cycle?
A forced sale is the single most destructive event for capital preservation in commercial real estate.
Why?
If an investor lacks immediate corporate liquidity and a property experiences sudden massive vacancy or requires a catastrophic emergency capital expenditure, the investor may find themselves entirely unable to service the senior debt.
They are then legally forced to liquidate the asset quickly,
Invariably accepting a distressed price far below the intrinsic market value, simply to clear the immediate debt obligation and avoid foreclosure.
by maintaining strict, highly disciplined liquidity reserves, typically equivalent to 3 to 6 months of total operating expenses and total debt service across the entire portfolio. The investor essentially buys operational time.
This critical capital buffer allows them to absorb unexpected operational shocks, renegotiate leases from a position of stability, or simply wait out a temporary macroeconomic market depression.
This ensures that when they do finally choose to execute a sale, they do so strictly from a position of absolute financial strength, dictating the terms to the market and maximizing the final return on equity.
Precisely.
This concludes our comprehensive, highly detailed executive analysis of the methodologies presented in the book.
Before we close this masterclass, please take note that Practical Principles of Commercial Real Estate Investment is available globally at major retailers, including Amazon, Apple Books, Walmart, Barnes & Noble, Bull.com, Waterstones, and Exclusive Books,
as well as through your local library lending applications such as Overdrive, Libby, Hoopla, or Odilo.
Furthermore, we direct your attention strictly to the show notes of this session. There you will locate the Linktree URL, which provides direct, immediate access to connect with Willem Tait for professional retained advisory services, high-level management consulting, and his ongoing industry publications.
Does the strict, uncompromising adherence to quantitative financial metrics ultimately eliminate the art of the deal, or does it merely define the rigorous boundaries within which true institutional executive creativity can safely and profitably operate? That is the structural question to consider as you apply these frameworks to your own enterprise operations. We look forward to many more analytical sessions hereafter on the wider publication portfolio of Willem Tait.